All right. I'd like to take this opportunity and discuss question number two on your chapter four homework. Okay. Some of you are asking for a video, so I'm responding to that request. All right. And if you have not done this, please pause the video and try it on your own first. All right. So let's look at the question here. A company is considering buying a new machine for one of its factories. The cost of the machine is $60,000 and the lifespan is 5 years and only it's expected. So it could be, 4 years, could be 6 years, but let's just say it's 5 years. Just make our lives a lot easier. All right. The machine will save the cost, at 22,500 every year. Now, here's the interesting thing. The book value of the machine at the end of year five is 10,000, but the company estimates that the market value will be only 5,000. So there's a difference between the book value and the market value. And the question is asking what is the NPV of this machine if the discount rate is 12% and the tax rate is 30%. Okay. Also assume straight line depreciation over 5 years. All right. So this is number two, chapter four, homework. Okay, and our analysis is very simple. We need to consider tax, okay, depreciation, all right, and essentially NPVs, all right. So let me just build a simple timeline and let's just start analyzing the after-tax cash flows. Again, our methodology is if there's tax, let's consider after-tax cash flows. Okay, so I'm going to look at a 5-year horizon here, and I'm going to look at first of all machine cost. Okay, so the machine cost is 60,000. All right, so I'm just going to put down negative 60,000. Okay, and let's look at the savings per year. All right, the question is saying the machine is going to save. Maybe you can actually, put the worker to some other use. All right. And so it's going to save 22,500 every year. All right. It's the same savings. So let me just copy this across. Okay. And now let's look at the book value. All right. So the book value is actually 10,000. So let's look at annual depreciation. So this is where some of you might be actually confused. All right. And remember, the book value is the machine cost minus the total amount that has been depreciated. So in this case, the book value is 10,000. The machine is costing 60,000. That means the total depreciation is going to be 50,000. And this is going to be depreciated over 5 years. So immediately we can calculate what is the annual depreciation. This is straight line. So this is the machine cost of 60,000 minus what is left after 5 years. So this is the total amount of depreciation, and we're just going to do a straight line. So this is $10,000 depreciation every year. Okay. So if you actually reverse this, 60,000 minus the total, you get $10,000 book value. All right. Now there is the market value of only 5,000. So what does this mean to you? Well, this means that on the accounting book, the machine is actually worth 10,000, but on the market, the machine is only worth 5,000. So that is like you actually sustained a loss, a capital loss of $5,000. And the IRS says, I can actually give you tax credit. Okay, if it is a capital gain, you have to pay me tax. If it's a capital loss, I can actually give you a tax benefit or tax credit, right? And imagine in the real world, sometimes you talk about carryover. Okay, so if you have capital losses this year, and if you have tax credits from previous years, you can actually use previous year's tax credits to actually make up for the loss. Okay, and let's look at your after-tax cash flow now. Okay, so this is our ultimate goal in order for us to actually calculate the NPV. All right. So let me just look at the first 4 years here, and then I'll elaborate on the fifth year cash flow. Okay. So remember, there are two ways for you to get the cash flow. One is, you take the savings, that is like your cash inflow, and you take out depreciation, and then you pay tax. Okay. So 1 minus 30% tax. Okay. And what, because now you took out depreciation, so you need to put back depreciation. Okay, so that is 18,750, and I'm going to copy this across to year 4 and actually to year 5 as well. But now I have to be very careful with year 5. All right, so this highlighted part is the this is the after tax cash flow caused by the depreciation, the tax benefits, and the savings. Now, don't forget, at the end of year 5, the machine it's still worth 5,000. So let me put back 5,000. And don't forget, because the book value is actually 10,000, the market value is only 5,000. So you have a capital loss of 5,000, and you're going to get 30% tax credit of the 5,000. So 5,000 times 30% tax credit. All right, so that is going to be your after tax cash flow. So now with this, I can calculate the MPV. This is going to be equal to, the rate is 12%. Okay, and the values would be the future cash flows. All right, and then let me put back the initial investment. All right, that should be our net present value. And this again is a messed up format. So let me just go ahead and put a dollar thing here. All right, $11,278. This replicates the answer. Okay, so I hope this is useful. The most confusing part is, what are you going to do for the cash flows in year 5? The cash flows in year 5, you actually look at the savings, look at the depreciation, look at tax, but also you need to look at the market value and also the tax credit. Okay, so this concludes my video for number 2. All right, so I'll stop the video here.